Section 5. Hedging with stock index futures. Before talking about hedging, let's first introduce the stock index futures. Stock index futures originated in 1982 when the Kansas City Board of Trade introduced the Value Line Stock Index futures. Value Line Index is an equal-weighted stock index containing 1,700 companies from the New York Stock Exchange, American Stock Exchange, NASDAQ, and the over-the-counter market. There are now stock index futures based on the Standard & Poor's 500 index, the Nikkei 225 stock average, the NYSE Composite Index, Dow Jones Industrial Average Index, etc. The S&P 500 index futures is based on the S&P 500 index and can be used to hedge a portfolio whose beta is based on S&P 500. The minimum fluctuation, the so-called tick size, is 0.05 point. The value of a contract was initially $500 times the index. Thus, a change of 1 tick represented a change of $500 times 0.05, that is, $25. Starting from 1st of November 1997, the value of one contract is $250 times the index. Here's an example. Consider a 3-month futures contract on the S&P 500 index. Suppose that stocks underlying the index provide a continuous dividend yield of 3% per annum. The current value of the index is 1,920, and the interest rate R is 8% with continuous compounding. Since both the dividend yield and the interest rate given are compounded continuously, the theoretical futures price of the index can be calculated as follows. And since each point of the index worth $250, its equivalent dollar value will be $486,037.5. With the basic understanding of the stock index futures, now let's talk about how they could be used for hedging an equity portfolio. According to the capital asset pricing model, the relation between the return on the portfolio of stocks and the return on the market can be described by a parameter beta. That is, the rate of return of the portfolio is approximately equal to some constant alpha plus beta times the rate of return of the market index. Note that both rates of return refers to that of the holding period. Let P0 be the current value of the portfolio, I0 be the current value of the market index, and the market index futures be valued at $M per point. During the holding period, the uncertain component of the change in the portfolio value and the change in the value of the market index are respectively P0 times beta times Ri and I0 times Ri. In the case when the broad market declined by Ri, the portfolio value will decrease by P0 times beta times Ri correspondingly. This is the so-called systematic risk of the portfolio, which could not be reduced by the portfolio diversification. However, it could be hedged by the market index futures. Because for market portfolio decline of Ri, one short futures contract on the market index will then gain by M times I0 times Ri. Let N be the number of index futures contracts required to totally offset the loss in the portfolio value. That is, we require the loss in the portfolio value to be exactly equal to the total gain from the short positions of the index futures. Therefore, N can be solved from the following equation, and we get it is equal to beta times P0 divided by M times I0. Such a hedge results in a hedged portfolio having zero beta, that is, free of systematic risk. This is also known as portfolio immunization. Rearranging the expression of N, we get that the beta is nothing but the hedge ratio defined in the previous section, that is, the size of the position taken in the futures divided by the size of the exposure. Recall the CAPM theory. The portfolio beta is defined by the covariance between the rate of return of the portfolio and that of the market, divided by the variance of the rate of the return of the market. This is exactly the optimal hedge ratio that results in a hedged portfolio with minimum variance shown in the previous section. More generally, the short hedge can be applied to alter the beta of a portfolio. To change the beta from beta 1 to beta 2, we simply short beta 1 minus beta 2 times P0 divided by M times I0 number of futures contracts. A perfectly hedged portfolio has zero beta, and that corresponds to choosing beta 2 to be 0. Here's an example of portfolio immunization. Mrs. Smith owns a large portfolio that is heavily weighted toward high technology stocks, which are believed to have high chances of outperforming the rest of the market over the next 4 months. She realizes that her portfolio with a beta of 1.25 is exposed to a significant degree of market risk. How would you do to help her to hedge against the market risk by performing a portfolio immunization, given that her portfolio was $2.4 million? Given the beta of the portfolio is 1.25, that is, the optimal hedge ratio is 1.25. And since the size of the exposure is $2.4 million, the size of the short position taken in the futures should worth 2.4 million times 1.25, that is, $3 million. We decided to accomplish this with S&P 500 index futures that matures in 120 days. Suppose the current spot S&P 500 index is 2,000 points. Then by the formula of N derived earlier, the hedge requires us to short 6 contracts in order to achieve a zero beta hedged portfolio. Up to now, we have finished Chapter 2, where we have studied forward and futures contracts, including how to determine a forward or futures price, how to evaluate a forward or futures contract, and how the futures are traded in the market in daily practices. In addition, we have also learned how the forward or futures contract can be used for hedging, particularly the minimum variance hedge strategy for cross-hedging. Next chapter, we're going to introduce another popular financial instrument, the swaps.